Hi guys, welcome back to my channel. So today we are going to discuss something very important, something which often goes around in everyone's mind, something which has been a long lasting matter of debate between the professionals. So it is whether to choose NPV or IRR in your financial decision making. So for those who are not aware of these two terms, so let me just make you understand the importance of these two terms. Then we will understand in what are the situations you should be choosing NPV and in what are the situations you should be choosing IRR. So let's say if you have 10 lakhs in hand and if you want to invest it under two options. Option A is that you can buy a shop in Mumbai for rupees 10 lakhs and you will be receiving rental income out of it, which will again increase gradually, say by 5% or 10% every year. Option 2 is you can invest the same amount in your friend's startup. Now the startup is new. There is a lot of risk involved in it. You might not get any amount in the initial years, but if the startup booms, if the valuation of the startup increases, then you might get multiple times return on this investment as compared to option 1. Now if I'll ask you a question that okay, now tell me which option is more viable to you. Again, as a layman, everyone will say that okay, I don't want to take risk, so I'll just go with option A. Or if a person who loves taking risk, they might prefer option 2. But if you'll ask a true finance professional, they will not give you answer in such vague terms. They will tell you that okay, give me the projected cash flows which you're planning to get from both the projects. And then they will, based on the NPV and IRR, give you a decision that what are the situations which you need to factor and in what are the conditions it will be better for you to go for project A vis-a-vis project B. So I hope these two terms might be clear to you. If it is not clear, just let me know in the comments. I'll make a detailed video on why exactly NPV and IRR are used in financial decision making. Now, coming back to our question, which one to choose, NPV or IRR? Just to give you an overview, and what does NPV mean? The full form of NPV is net present value. It basically means that let's say if you have invested 10 lakhs on day 0 in a project and if you're getting say 1 lakh each year, now the 1 lakh which you will be getting in the further year, the present value of that will definitely be less than 1 lakh. If I'll explain you in a simple term, let's say if you're having 100 rupees now and if you'll keep it in your almirah and if you'll pull out the same 100 rupees after 3 years from your almirah, the value of that 100 rupees will go down significantly. Reason being inflation. Because the value of your money has degraded because you have not kept it in an instrument which will give you the similar return to beat the inflation. That's the reason it is never recommended to keep maximum amount in cash. So coming back to the concept of NPV, NPV basically means that whatever present value of the future cash flows which you have calculated, we will now compare it with our initial investment. And if the inflows, present value of the inflows are more than the initial outflow, automatically it means that your NPV is positive, and if you will invest in such a project, you will be getting surplus money out of it. And if the initial outflow, which is the cash outflow, is more as compared to cash inflows which you will be getting over the years, automatically it means that if you will be going ahead in this project, then you will be making a loss and your value of 10 lakhs will degrade over the years. So this is NPV explained in simple terms. Now there are many nuances around it, that what is the discounting rate which we should consider to discount the future cash flows. Again, that is a discussion for a separate video altogether. Now coming to the concept of IRR. What does IRR mean? IRR basically means internal rate of return. It basically means that say suppose if you have a cash outflow of rupees 10 lakhs on day 0 and if you will be getting 1 lakh over the years, then what is the amount of return which you will be getting through this project? So IRR in simple words, it basically means that what is the discounting rate of return which will make your cash outflow equal to cash inflow. And then let's say if we get 10% as IRR, then that 10% will be compared with the expected rate of return. Let's say if I wouldn't have put this 10 lakhs in this particular project, I would have put it in mutual funds. And that mutual fund would have given me a return of 12% per annum. But this particular project is giving you a return of just 10%. In such a scenario, if we go based on the IRR, we will not prefer this project at all. Reason being because our expected rate of return is higher than the internal rate of return which this project will generate. So this is the simple meaning of IRR. Again, there are many nuances, many reinvestment concepts in IRR that will not cover in this video. Now coming back to our discussion, which one to choose, NPV or IRR. So let us understand this with the help of some simple examples. So we have a data set over here where there is project 1 and project 2. If you'll see the cash flows of project 1, in year 0, the initial investment is 1000 rupees and this is the cash inflows over the years. And you will notice that there is a cash outflow in the year 4th, which is minus 2200. Now this will create a difference altogether. If you look at project 2, there is also an initial investment of rupees 1000 in year 0, but over the years you can see that there are positive cash flows. Now let's calculate IRR in this Excel sheet. For those who are not aware, there is a specific formula of IRR which is there in Excel. The formula is equal IRR. So what you need to do is you need to just select the values in sequential order over the years. Like I have selected from this year till this year. It basically means that the first value which I have selected, that is the base year, and the further values which I have selected, those are for incremental years. I'll just close the bracket and click on enter. You can see that we are getting a 6.6% IRR. So just let me know in the comments, pause this video, let me know in the comments, do you think this 6.6% is the right answer? Reason being that what is the meaning of IRR? IRR basically means when NPV is equal to 0. So basically when outflow is equal to present value of the future cash flows. In this case, there will be two situations where NPV will be equal to 0. I'll just prove it to you with the help of a graph. So this example has been taken from the notes of Mr. Damodaran and he had only put on this graph. So this is the particular graph which I'm referring to. So how to read this graph? The x-axis, which is the horizontal line, that basically contains the discounting rate or the rate of return or the internal rate of return. And the y-axis contains the NPV. So as per the definition, IRR is equal to when NPV is equal to 0. Now we are just looking at project 1 line over here. Now here you can see that we have got around 6%, right? The IRR which we have received. So that is the first IRR which is there, because at that stage your NPV is 0. But if you will progress, I'll just put this graph adjacent to the cash flows which we have. But if we will progress, you can see that there is a negative cash flow in year 4th. And because of that, again in further years, your NPV will be equal to 0. That's the reason we are getting one more IRR over here. Now you will say that, okay, our formula gave us 6.6%, but how can you exactly get it with the help of this particular formula? How can we get the second IRR with the help of this particular formula? So what I will do is, I will again type equal IRR. I'll select the cash flows which I have. I'll give a comma. Now in this guess, I will just put it a guess. Here just looking at apparently, it should be somewhere around 34%, right? So what I will do is, I'll just write 34%. So this is my guess, which I'm telling Excel that, okay, this is my guess of IRR. Now Excel will see that if there is any IRR near to my guess, automatically we'll get the answer as 36.55%. So this 36.55% is the second IRR of project number 1. And as a thumb rule, keep this in your mind, as a thumb rule, if there is a particular project where your cash flow is getting negative, your overall cash flow is getting negative over the further years, and because of that your NPV is also becoming 0 in the further year, automatically you will get 2 IRRs. And whenever you have 2 IRRs, IRR will not give you the right representation of the project. It is always recommended to go with the NPV approach. Now let us just have a look at it. I will calculate NPV of this project. How we will calculate the NPV? Again, we have a formula in place. I will type equal NPV. First, we need to select the discounting rate. So my WACC or the weighted average cost of capital is 12%. Then I will have to select the cash flows. I'll just select all the cash flows together. I'll close the bracket and click on enter. My NPV is positive, which is 34.51 rupees. So as a thumb rule, if your NPV is positive, that project should be acceptable. Now let us just have a look at project number 2. So let us just calculate IRR equal IRR. I'll just select the values, close the bracket and click on enter. We are getting the IRR as 12.83%. Now in this case, there cannot be a concept of a second IRR. Why there cannot be a concept of second IRR? Because the cash flows are remaining positive throughout the project cycle. Let us just calculate the NPV very quickly. I will type equal NPV. The rate is 12%. I'll give a comma. I'll select the list of values, close the bracket and click on enter. My NPV is 18.04. So which project will you choose? Project 1 or project 2? So IRR has become irrelevant. So we'll not go using the IRR approach. If we'll just look at the NPV approach, it apparently suggests that project 1 will give us a positive cash flow over the years, and it is recommended to go with project 1 as compared to project 2. So this is how your decision making will be done in such a scenario. Let us look at a different scenario altogether and see whether we should choose NPV or IRR for our decision making purpose. So here is example number 2. Here also we have the list of cash flows. For project A, there is an initial investment amount of rupees 10 lakhs and we have positive cash flows over the years. And for project B, we have an initial investment amount of 1 crore and we have positive cash flows over the years too. Let us just very quickly calculate the IRR. So the formula is equal IRR. I'll select the values, close the bracket and click on enter. So the IRR of project A is 33.66% and the IRR of project B is 21%. I'll just keep the formatting same. Yeah, it is near about 20.88%. Same for NPV. I'll calculate equal NPV. Rate is 12%, discounting rate. I'll select the values, close the bracket and click on enter. So it is near about 5,13,000, right? The NPV of project A. So what will be the NPV of project B? Equal NPV. This is my discounting rate, comma. These are the cash flows which are there. Close the bracket, click on enter. It is about 19,34,000. I'll just expand it. Yeah, it is 19,34,000. Now, this is where the question arises. If we just look at IRR, you can see that project A is more preferable because IRR of project A is substantially higher as compared to IRR of project B. But if we look at NPV, you can see that the NPV of project A is substantially lower as compared to NPV of project B. Now, just pause this video and let me know in the comment. So guys, make sure you brainstorm throughout this video. That will help you to enhance your thinking ability in finance. Now, what do you think? If you would have been the financial advisor of this particular firm, would you have recommended your client to go with project A or project B? Well, there cannot be a simple answer to it. There are pros and cons of both of these projects. Now, in finance, there is a term which is known as capital rationing. So what is the meaning of capital rationing? Capital rationing basically means that if you have limited amount of capital in hand and if you have multiple projects in which you can invest, then it is always and always recommended to choose the IRR approach. Let's say in this case, let's say if I have limited capital, now what we will do is try to optimize the amount of return which we can get for that particular capital. If you have limited capital, always and always choose that project which will generate the highest IRR. But let's say if we don't have any such constraint of capital, if you have sufficient amount of capital in hand and there are many projects which are there and that capital can accommodate all such projects, in such a scenario, it is always recommended to go with all such projects which is giving you a positive NPV. Reason being that all such projects will give you a positive return in a longer period of time. That's the reason it is always recommended to go with the IRR approach if you have limited amount of capital and choose the NPV approach if capital is not an issue and you can invest on multiple projects at once. But guys, at the same time, you also need to make sure that the IRR which you are getting, that should be higher than your required rate of return or the hurdle rate, and your NPV should be more than 0. So these are the two base criteria. Once these two criteria are satisfied, then only we will decide whether to choose project A or project B based on the conditions which I have just mentioned. So guys, that's all in this video. I hope you guys found this video helpful. So this is just a start, guys. I'll make sure that I'll come up with more informative content on core finance for you all so that it will not only make you progress in your career but also understand finance in simple language. So understanding finance has various advantages. It will help you to make a wiser decision. It will help you to even make your investment strategies for stock market. Yes, you can project the cash flows of the companies, and using the approaches which you are following, you can even decide the value of the company and whether you should be investing in that particular company or not. So guys, don't forget to give a thumbs up to this video and make sure you subscribe to my channel. I'll make sure to come out with such informative content on every alternate day. Thank you so much. This is Rajat signing off.